All right, what's going on, everybody? I hope you all are having a great day. The last couple days, I've been just reviewing my performance over November because this has been a little bit more of a challenging month for me just after the elections. Market conditions have changed, and yeah, I found myself in a bit of a losing streak. This month, I've taken 5 losses and only 2 wins, and yeah, I was reviewing my performance and I realized that the only reason why I'm not in a hole right now is because of my risk management. That has been the only thing that's been keeping me afloat and in a little bit of profit. So I was looking through it and I kind of made some connections with how I've been, I guess, managing my risk and mitigating losses compared to how traditional businesses do that as well. And I started doing some research and I thought you guys would find this interesting. Like, in like a traditional retail business where they're buying and selling products, their average markup percentage on a product is only 50%. So in trading terms, that would be 0.5 uh risk to reward per product they sell. And the profit margins are really small as well. They're usually working with between 0.5% to 10% profit margin each year. And yeah, that's like you coming out with 10% profit at the end of the year after all expenses are paid. So in trading, we're definitely blessed in the sense that we can to call it, we have a lot greater potential to earn a higher reward for our risk and come out with much larger profit margins. Um, Problem is a lot of people don't recognize that, the reason people don't win in this industry is because they're not mitigating losses and managing risk like a normal business, treat it like a game. So yeah, these are very small and tight margins, which means there's a lot of risk involved. And the question is, what do they do to mitigate as much loss as possible? So I kind of just wanted to go over how traditional businesses mitigate their losses and how we could kind of apply these concepts into our lens of trading, and maybe you can gain something from this. If not, it's all right. But I found this interesting. So let's say at the first sign of an ineffective product, um, businesses will try to attempt to break even. Think clearancing out items or calling out damaged products at 50% of the price. Um, and maybe a correlation to trading would be like, did your trade fail to follow through the initial high or low that you were seeking for? Is it showing signs of mitigation at opposing levels? Um, this would be your time to bring your stop loss to break even because your asset is showing signs of ineffectiveness. And once a product is proven faulty, let's say partially broken or missing parts, they will sell it at a larger discount, 70, 80, 90%, to at least cut down on their loss. And this is quite consistent in businesses. And a correlation with that would be like, is the market showing you this trade is not going to work? Is order flow maintaining into your stop loss? Is there no sign of it slowing down? Cut down on that loss as much as possible. It's simply every single trade you're trying to mitigate as much risk as you possibly can to keep your losses smaller. And obviously, after all attempts to mitigate loss, it is still normal to have to throw away damaged product, but that just won't sell. But that is after every attempt to mitigate as much risk as possible. The same thinking should be applied to trading. Taking full losses is going to happen, just like any business. But the name of the game is reducing your losses as much as possible so the profitable sales can shine. So I guess my takeaway here, like looking at other businesses, is yeah, risk to reward targets don't matter as much as mitigating loss as best as possible. Risk management is much more important than swinging for larger trades. So if a majority of your losses are kept below your initial risk, stacking up 1-to-1s, 1 to 0.75 trades, 1 to 2s, etc., will act as larger RR trades in the grand scheme of your career. Now I want to give some examples. I'll show you all my trades from last month and this month, just so you can see the sequence of my wins and losses, and show you that large trades don't necessarily matter if you're mitigating your losses correctly and managing risk. So this is October. My first trade was a break even. Second trade was a minus 0.6 R loss. Third trade was a break even. My fourth trade was a 0.7 R win. Fifth was a break even. My sixth trade was a minus 1% loss. Seventh trade was a 1.7 R. Eighth was 2 R. Ninth was 0.68 R. 10th was 1 R. You can see that these trades are not, home runs. They're all just little base hits just to lock in as many profitable trades as possible. And you can also see my losing trades are all usually under 1. I'll take a few full stop loss hits because it's normal, but 11th was a break even, 12th was minus 1 R. So after all of this, even though my numbers don't seem good at the onset, I still pulled 4% profit this month. It's those little base hits add up if you are mitigating your losses properly. And I'll show you this month because it's been a little rough. I've taken 5 losses and 2 wins, yet I'm still up 1%. And I haven't hit any home runs. First trade minus 0.47% loss. Second minus 0.22% loss. Third plus 1.18% win. Fourth minus 0.39% loss. Fifth minus 0.7. Sixth minus 1. Seventh was a break even. And then the last trade I've taken so far was a win on gold for 2.6%. And I'll kind of let me break down how I manage my trades. So let's say we come into a point of interest here, we run liquidity, and then we see a sweep on the highs and an aggressive breakdown. And obviously I'm trading pro trend of the 1 hour and the daily. So let's say lower time frame order flow is starting to realign with that. I'll wait for an entry in a point of interest. Let's just say for this instance, it's right here. And once we get tagged in, I'm immediately looking at levels that are opposing to me that I could possibly mitigate risk at. So let's say we have this sell to buy zone here. Let's see. And then we have the extreme of the leg here. This is a good practice as well because it keeps you open to what the market is actually showing you. You're not just single bias to your entry. So let's say I get tagged in and market gets a nice reaction out of my zone. If that's the case, and we come into our opposing levels, let's say my risk was here, I'll immediately start trailing my risk down. So if we come into opposing levels and the market shows an aggressive reaction out of here, it's likely to take out these highs, okay? So if that's the case and we reach opposing levels, my risk is off the table. Same thing. Let's see. Same thing if we come to the low and we fail to break through, which is what we want to see. We want to see a follow through in price. If price stops here and we aggressively start running back up, it's likely that this high is deemed as weak. Okay. So I'm either going to go to break even, or if this is the last point of validity for my trade, I'm going to trail my stop loss into a little bit of profit. And it's the same for every single trade. And obviously it doesn't always look like this. There's different levels and sometimes price will mess around in your entry. Yeah, let me just give some examples here. All right, let's take oil. So on the 1 hour and on the daily, we are flowing bearish. We had a run on buy side liquidity. We had a sweep and aggressive breakdown showing that there's some intent to come to the downside. I entered in my level after sweep of inducement and we got a nice reaction. So at this point, I'm already thinking I should start mitigating risk a little bit because if we fail and continue expanding up, there's not much stopping it here. So we come to the aftermath. We mitigated, we started breaking down twice. It's unlikely if it's going to continue, we're going to sweep up and then continue back down. So what I did was I brought my risk down below this high because this is the last point of invalidation. So instead of taking a full risk loss, I'm taking a minus 0.22% loss. Let's see. Same thing. We're in bearish order flow. Price ran buy side liquidity, mitigated this OB and broke down aggressively. This was a little rough of an entry because we were coming in pretty aggressively as well, but I took the trade. And then my management, you can see, we got that reaction, we got a follow through, and price is holding this bullish OB. So if we're holding these levels, it's likely to continue expanding up. I don't want to be in this trade if it's working against me. It's an ineffective asset. So I reduced my risk down to above this last point of validation, and I took that half risk loss. And it's the same for every single trade. I do the exact same thing over and over again. And you can see my losses whenever I am wrong, which is normal. They're much smaller than whenever they just allow my wins to shine, even though I'm taking sometimes more losses than wins. Um, that's about it. I want to keep this short and simple. Might be something interesting to think about, and maybe you can apply this into your trading to, I guess, just mitigate your losses better and manage risk. You all have a great rest of your day. Uh, take care.